Let's talk about precious metals for a second here, because that was, everybody heard the same thing. Gold prices are screaming higher. That must mean the dollar has to go lower because, as we know, the only reason that gold would be higher is because the dollar is going to zero. That certainly wasn't the case, but that was the narrative. And it seemed like it was plausible for a time, which why it captured so much attention. And I think why it got so ingrained into mainstream psychology was because look at gold. Gold is telling you the dollar's going to zero. So here it is and here it comes. That not being the case, so why did gold go up and why isn't gold going up? I mean, look, you can make a clear correlation with the Iran conflict because gold was going up. Yeah, it's high. It hit its ultimate high in early January. So it's coming off the high to begin with. But you look at the chart, February 27th, the war starts and gold kind of goes down there. So
Yeah, I charted it out. It literally from the day the war started until the MOU was signed, gold went down 24%.
yeah. So the question is, what was gold actually telling us? If not the dollar going to zero, which well, let's dispense with all.
Yeah.
It
Yeah.
was never what it wasn't a debasement trade. So what was gold actually telling us last year?
So here's my take on it. I think part of it is the debasement trade. They over time, countries know that, or institutions, buyers, market participants know that dollar loses value over time. So you want to diversify out of fiat and get into something else. They already own equities. They already own treasury bonds. Gold is kind of a neutral asset that the whole world has a history of wanting. And so that becomes a reserve asset because it's time tested, right? And you can move it in huge quantities very quickly. For all the reasons that people buy gold, I think that's why gold did well last year. Now, I think what happened this year, oh, I should also say, I think it's a result of, the way the United States is dealing with the rest of the world now is no longer by this rules-based order that is for the greater good. It is now an America first, very transactional, one-on-one way of dealing with the rest of the world. And we're no longer negotiating multilateral treaties for the good of everyone. We are, implementing one-way treaties for the good of the United States. That's a much different way than dealing with the rest of the world. And after the United States froze the Russian reserves, I think, institutions and central banks around the world are looking and saying, hey, we should probably have something other than just treasury bonds, right? Not only because they lose value over time, but or the dollar loses value over time, but also just for diversification. So I think there was some of that. And so, you've seen those charts as I have that gold is now a bigger percent of reserves than US treasuries. What is never explained on those is it's largely due to price and not number of units held. It's not, it's not that the tons haven't gone up and it's not that the number of bonds held hasn't fallen, but the chart inverted basically because of treasury prices falling 20 or 30% and gold rising 100%, right? So that's a big reason those charts look like that. But I think this year, what has happened to gold and silver, I think is a perfect reflection of it becoming a reserve asset. And what I mean by that is, what is the point of buying reserves in the first place? It's the same reason you have a piggy bank. That's essentially what it is. Foreign exchange reserves for countries is like an individual having a piggy bank. And when it starts to run, when that rainy day shows up and it starts to rain, sometimes you have to go into your piggy bank, right? And so earlier this year, when the Iran conflict breaks off and liquidity gets tight, you have to go and you have to tap your reserves. Well, if you let's just keep it simple. Let's say you've got two different types of reserves. One of them is down 20% from where you bought it. It's treasury bonds. And the other one is up 50, 60, 70% from where you bought it, which is gold. Now you have to tap one of them in order to get dollars because you still need dollars to operate on the global stage. So what do you sell? Well, you probably sit there and you think, well, bonds are probably undervalued a little bit and gold's probably overvalued a little bit. So I'm going to sell the one that's gone up a lot and I'm going to wait for the treasury bonds to either come back or mature rather than selling them at a loss. If I hold them to maturity, I'm going to get 20 cents more on the dollar than I get now or whatever. I'm exaggerating, but you sell it early, you have to take the early withdrawal penalty as a result of interest rates, but gold is up. So you sell the gold. And so I think you saw Turkey sell gold, you saw Russia sell gold, you saw the Gulf states who were most impacted sell gold. And it happened right when the war. I don't think the fact that it started falling the day after the war kicked off and it bottomed the day the MOU is. I don't think that's a coincidence, right? And so so this is what if for the people who are big gold advocates, which listen, I am. I think everybody should own gold. I think over time it's going to end up going a lot higher. But if you are going to advocate for gold being a reserve asset, reserves get used when they're needed. And that means they get sold, right? Gold doesn't help you if you're not willing to sell it. I think gold did exactly what it was supposed to do. They bought it because they knew they might need it in some kind of a crisis or in some kind of a liquidity event. The liquidity event showed up, and so they sold the gold, which is exactly why they bought it in the first place.
It
And I
wasn't
think it
always
helped.
a reaction either, right, Brent? I mean, if
Yeah.
you're one of these Middle Eastern states and you probably catch wind that the US is moving assets toward Iran, you start proactively selling your gold today. So, I mean,
Yeah,
there's a good likelihood that the selling that happened in February, long before we got to the actual conflict, was some of these states saying, you know what, I might want to raise my liquid dollar balances. I'm going to get, just as you
that's
said,
right.
I've got gold sitting there. It's doing its job perfectly. It's been going up in value. I can get a good price for it. So I'm going to sell some preemptively and prudently to raise my liquid dollar balances. And I think that we saw a lot of that happen, right, as you said, right on through to
Yep.
the MOU under being signed.
Well, and I think, there's probably some people out there saying, "Well, why would they sell the gold? The bonds are just going to continue to lose value." Well, maybe they will, maybe they won't. But there's other factors here too, right? Like if the Gulf states start fire selling treasuries, that's not going to make the United States very happy, and so then that's not going to, there's geopolitical things going on behind the scenes other than just finance, right? And
Well, to be
so
clear, let's the data that we have from either the Federal Reserve Bank of New York or the Treasury Department, there has been a lot of Treasury sales. It hasn't just been gold.
right,
A lot of governments
absolutely.
have been selling all the reserve assets, which again, any prudent manager would do. You don't just sell one or another. You kind of diversify your sales. You diversify your liquidation. So that happened too.
Exactly, and yeah, and listen, we know for sure. And listen, I need to tell you this because I can't remember if we spoke since this, but I was at a conference in April, and I was talking to a guy who is a senior executive at the Bank of Abu Dhabi, and he was saying this was, right in the middle of everything going on, and he's like, we have, business has basically dried up. We have zero demand for dirhams. We have zero demand for yuan business. All of our demand is for dollars. And that was about the same. And so, that's just one bank, right? And so all the banks needed dollar funding. And that's about the time that they came out and said, we would like to potentially get a swap line
Yeah.
from the US Treasury, right? And so that's another reason why they perhaps would sell gold rather than sell treasuries, because you still need dollars to operate on the global stage. And if the crisis gets worse, you're going to need a swap line. So you don't want to be fire selling all your treasuries if you're also going back to Scott Besson and saying, hey, or to, War saying, hey, I need a swap line. And they're going to say, well, then sell some of your gold. And they'll say, well, we just won't sell our treasuries and then we'll get the swap line. So
Well, you need the
the
Treasury's
point,
collateral anyway.
exactly. This is the part okay, I'm glad you brought that up. We should talk about this a little bit because I know people who work at institutions probably understand this better than individual investors, retail investors. Financial institutions don't buy treasury bonds because they think they're a great investment. They buy them because they are the collateral off of which almost all banking takes place, right? So they're not necessarily buying a treasury bond at 95 cents on the dollar, hoping to hold it for, however, 10, 15 years, going back to 100 cents on the dollar and clipping the coupon. They use that as collateral to make loans and operate, a bank. They make a spread, right? They earn, I don't know, 4% on their treasury bond and they loan out at 2% and they make the spread or whatever it is. Or they pay 2% on their, 6%, right? They borrow it. They're earning 4 and they're making 6 or whatever. And so I think it's important to understand when the biggest buyers of treasury bonds, regardless of what the price is, whether interest rates are going up, whether interest rates are going down, the biggest buyers don't really care about the price. They just want to be able to make a spread over it because that's the banking that they do. You're probably better at explaining this than I am, but I think it's an important thing to understand because I talk to so many people that say, well, nobody's going to buy bonds anymore. Well, that's just not how it works, right?
It's like the dollar. You don't have a choice. It's built into your business. Your business demands that you have these assets at your fingertips, or at least to have the ability to get them someplace else. So
Yeah.
it's built in demand. And you're right. It's collateral. Collateral is everything. It's not just, hey, you got to have collateral when things are going wrong. You got to have collateral to get things to go right. It's built into how your business is operating under the best of times. So
Yeah.
collateral is there as an emergency piggy bank. It's there as, the basis for your business. You want to get money coming in the door so that you can earn a spread. Well, that's how you do it. You've got collateral assets there that can bring you in funds that then allow you to buy assets, financial assets to play in these marketplaces, to become a dealer. You got to have the collateral to begin with. And
Yeah.
so, yeah, that's a huge part of it as well.
What are I I know you put out so much work, it's hard for me to keep up with all of it. But what are you seeing with regard to that? With the dollar funding and the credit, whether it's plentiful or not.
Well, you still see all the same signals that you saw earlier.
Yeah.
The dollar exchange value against certain currencies, especially those that are most susceptible to the energy shock, are still weak. Governments have responded as best they can, but that's always a short run situation. In fact, a lot of these governments have continued to escalate the situation or escalate their countermeasures. I mean, Japan is a perfect example, to the point the Japanese actually spoke some truth, whether it was accidental or not, saying, hey, you know what? These rate hikes by the Bank of Japan actually aren't working. Maybe we actually need to get some of these Japanese financial firms to keep some of their money home instead of carry trading it all around the rest of the world, which was finally closer to the truth than not. And then, of course, earlier today, I just saw this on Bloomberg. Oh, never mind. We're not going to do that. So the point is, you still see the dollar exchange value, which is a very simple thing. But some of the statistics and data that you get, which are always imperfect, they continue to show that reserve assets are being mobilized in various different ways. And it's not always, sell your treasuries or sell your gold. You can lease your gold, which is one of the things that Turkey did early on in the Iran conflict. They leased a ton of gold, a figurative ton. It was actually several tons of gold to raise dollar liquidity. We've seen collateral swaps with U.S. Treasuries that took place. So all of the things that you were mentioning earlier on, where everybody needs more dollars, well, you got to find a way to get them, and you dip into your reserve pile in any different way that you possibly can.